for being, getting together. There are different reasons when you put always join together. As I explained you previous lecture, you are putting different resources. We call it pooling resources. Now, for example, suppose aircraft manufacturer, when you are undertaking a contract to produce an aircraft or aeroplane, one can really focus on the engine. They are expert on engine. Other party may focus on body of the aircraft. Another party may focus on the software system, IT system in the aircraft. All the systems is really done by a separate party. Those expertise or expertise knowledge is required when getting a order to produce a aircraft. Then there is a tendency of getting 2-3 people together and produce the aircraft. So there you put the different resources together. That's the meaning of here. You maybe to share cost, share the risk, manage the risk, and share the technology and new market, etc. With regard to the joint arrangement, joint arrangement arises where two or more entities have an agreement. There's an agreement between each other such that these entities have joint control of the arrangement. The word is joint control. Joint control means, I think you can remember in consolidate financial statement, control, that is domination by one party. If you have 90% shares, 60% shares, so you have the dominating power. You lead, you dominate. But in associate companies, you talk about you perform the significant influence role in financing and operating decision-making process. Thereby you, in a way, even though you are not dominating, you are significantly influencing in the decision-making process. But in joint control mechanism, so you jointly, not only one, but also with other people, you jointly control. So that is the meaning of joint control. The term management describes an activity or an operation. So there are operations, activity, which may or may not form a legal entity. So there may not be a company separate structure, and activity and operations. So then, of course, a joint arrangement has two main characteristics. The parties are bound by a contractual arrangement. When you say joint arrangement, parties are bound by a contractual arrangement. Contract generally may be writing or deal. The purpose of duration of the joint arrangement, how board members are appointed, how decisions are made, the capital and other contribution required of the parties, how the parties shares assets, liabilities, like a partnership agreement. The contractual arrangement is there. How to operate, how to control jointly. So thereby there should be agreement. That's called contractual arrangement. Then the contractual arrangement gives the parties joint control of the joint arrangement. Joint control is defined. The contractually agreed sharing of control of an arrangement which exceeds only when decision about the relevant activities require the unanimous consent of the parties sharing control. So thereby, to have the joint control, there are two things. One is sharing the control. Other one is unanimous consent. That means if there are two parties controlling jointly, so the two parties should agree. If there are three parties joint control, these three parties should jointly, unanimously consents. ඒ කියන්නේ අපි කියන්නේ ඒකමතිකව හැමෝගෙම කැමැත්තෙන් එකඟ වෙන්න ඕන කියන එක තමයි එතන කියන්නේ. That's the important point with regard to joint arrangement. The classification of joint arrangement, basically joint arrangement can be divided into two parts. One is joint operation, other one is joint venture. Joint operation, joint venture. An arrangement in which parties that have joint control have right to assets and obligations for the liabilities relating to the arrangement. So thereby you are having the right for each assets, each liability, separate. Inventory, maybe cash, maybe a work in progress, maybe plant and machinery, maybe equipments. So you are having the right to assets, and you are having the right to obligation for the liabilities. That's the joint operation. But when you take joint venture, an arrangement in which the parties that have joint control have right to the net assets of the arrangement. So thereby you don't have a separate right for your assets of the operation. But here net assets, you know how to get the net assets. Net assets means total assets minus total liabilities. So if you have the net assets, very easy for you to account for joint ventures by equity method. That's why we are accounting joint ventures based on equity methods, because you jointly control, you have the right to net assets, not for individual assets. Then joint arrangement characteristics and classification. Judgment is required to classify a joint arrangement, not just straightforward decision. You need to consider. So these classification is little bit difficult, whether it's a joint arrangement or joint venture. So there are 4 criteria for you to decide whether it is a joint venture or joint arrangement. Structure of the arrangement, the legal form of the separate vehicle, the term of the contractual arrangement, any other relevant facts or circumstances. So based on these 4 factors, we will decide whether it is a joint venture or joint arrangement. So I think you can remember previous lecture, we discussed that the equity method, if it is a joint venture, you go for equity method. Okay, then coming back to again the classification, this is taken from the particular text and joint arrangement characteristics. You say first one is there are 4 factors: structure, legal form, term of contractual arrangements, and the other factors. First of all, we will look at the structure of the arrangement. Now, structure of the arrangement, if there is a separate structure, the question is whether there is a separate structure or not. Not a structure through a separate vehicle, structured through a separate vehicle. If there is no structure, of course, it's a joint operation. Structure means maybe separate company. So it's a joint operation. But if there is a structure through separate vehicle, if you have a separate structure, for example, a company board of, director boards, etc., the structure is there. Then there are other 3 factors. Entity shall consider the legal form, the term of contractual arrangements, and when relevant, the other facts and circumstances. So depending on this, it may be classified as joint operation, it may be classified as joint venture. For example, in the contractual arrangement, it says that particular operators are having the right for individual assets, having the right to individual assets, of course, then it's a joint operation. If it says that, no, it's not the case, so you have the right to net assets, then of course we are talking about the joint venture, something like that. So thereby structure, the legal form, contractual arrangements, any other factors will influence the decision whether to classify joint venture or joint operation. Accounting for joint venture is different from that of a joint operation. Accounting for joint venture. In joint venture, each venture has the interest in the investment. In joint arrangement, the equity method is used. So for the joint venture, equity methods. But accounting by the joint operation itself, where the joint operation is not conducted, we are a separate structure, a company, separate accounting records do not need to be kept. Not enough that SLFRS 11 provides no standards on accounting for the joint operation itself. No accounting, but we can have a discussion on how joint venture operations keep in their records. When joint venture does not sell the output itself, there will be no profit or no loss report. So if you just produce, you are not selling, then what you do is you share whatever you produce, you share by the joint operation 1 and joint. So example, joint operator 1, joint operator 2. Here, cost 1, cost 2, cost 3. You can remember the management accounting process cost, direct labor, direct material, other variables. So you get the WIP, then WIP convert into inventory. Inventory will be shared by the two operators. The statement of financial position in the joint operation, main financial state. Okay. Then the key features of joint operation is that the joint operator has an interest in the individual assets and liabilities of the joint operation. You have the interest in individual assets. In this situation where the joint operation produces an output which is distributed to the joint operator, each joint operator needs to recognize its share joint held assets and liabilities, share of profits, share of assets and liabilities, share of revenue, share of expenses, share of any other expenses incurred. So that is the base. Now, we need to do a small example after that. What I will do is, without looking for referring to the slides, I will straight go forward to the go straight go to the what do you call the chapter. We'll see there whether there is a chapter. Okay. Okay, what you can do is this document, can you just read this this particular example 2.4. Just read this what is being highlighted. हाँ नहीं नहीं वैसा नहीं नहीं वही कैंसर किया itu pas yang kan mau dikelas online oh tercancer itu ini kan bangga nasi ini kan tuh pagi ini mungkin ada dua orang Roger dekat pak anggotan yang kami itu orang yang Postus tiga lah yang kita minta dalam mana? AI ini, itu nanti itu pasti ini. Game tu, kerana game tu kan itu bukan apa game orang ini nak mungkin apa itu apa ni? Game lagi? Dan ya, belum. Bukan ini. Itu tamai. Itu regular ni apa? Itu kan mesti jadi kian. Game apa yang itu kan ni? Okay, shall we start? Again, I'm sorry, we had a small discussion on some other matter. Uh, Accounting by an unincorporated joint operation. This is unincorporated one example. 2015 July, X Limited and Y Limited sign an arrangement to form a joint operation to manufacture a product called glassboard. This product is used in packaging. Industry has the advantage of strength and protection qualities of cardboard, as well as flexibility and durability of plastic. Its joint venture is about producing plastic. And to commence the operation, both operators contributed 1,500, $1.5 million cash in example. So the double entry would be the operator's book, contributors by the cash would be now this is really you are keeping the accounts for the joint operations, right? Cash you debit for the operation, and the contribution of each operator will be credited by X and Y Limited. So that is the idea. That is the first journal entry. So each contributing 1.5 million, here 3 million, 1.5 million, 1.5 contribution. Now, based on that, you may purchase certain equipment. Maybe you may purchase material, you may take loans, activities of the business, transaction of the business taken place. Now, few transactions are given in terms of journals. The equipment they have purchased, generally, this is not really, we are accounting for joint arrangement. We just keep the accounts for joint operation in a separate set of books. Equipment account debit, cash credit, the equipment has purchased by cash by 500,000 and the loan equipment, a loan taken by 300. So thereby altogether 800. So we have created the loan account and created the, what do you call this, cash account. Acquisition of equipment by paying cash 500,000 and making a loan 300,000. Then the purchase of raw material, debit the raw material account and credit the creditors. Acquisition of then the wages, of course, wages debit. There are two types of wages: management wages and other wages. So debit and the cash, and there is a accrued wages of 20,000. So that's the double entry. Then borrowing from a banks, of course, cash debit, cash will increase, bank loan will increase, and repayment of the loan, repayment of the loan of other expenses, that is the equipment loan. Can you remember we use loan 300 to finance the equipment? Out of that 300, we are making 100, then it becomes 200 automatically. Loan account debit, cash credit. Then when we are making creditors, I think you can remember 650,000 raw material. We are settling part 420 and 420, and overhead expenses really 1.3 million and 1.3 million. Then the depreciation 800 accumulated depreciation, and so those are the transaction taken place. And once you purchase the raw material, it has to be processed, like process account. So thereby what happened is wages 720,000, which was incurred here. 200 and 520,000 wages account, 720,000, raw material 480. I think then the raw material balance is there. We are taking on a 650. Then overhead expenses, depreciations, we debit to the WIP progress, WIP accounts. So thereby, allocating cost to the WI work in progress. Then we move on to the transfer. Once the item completed, we transfer completed units from WIP to inventory. So thereby, according to this example, 1,800 has been transferred to finished good account. Now you see the work in progress account, we have 2,580. We are transferring so much. So there is a balance of work in progress. Then inventory is the final outcome. You see, we have produced 1,800 worth of inventory, and since we have 50% ownership, we are sharing the output 50%, 50%, that is 800 and 800. That is, so you are crediting the inventory. So thereby the balance inventory would be 200, because inventory account 1,800, we are taking 1.6 only. So thereby 0.2 remaining as inventory. Is it clear? Now, when we prepare the cash summary, cash account for the operation, now you remember this is the accounts for the operation. Equipment, wages, this is we are paying, even though wages is 720,000 here, wages 720,000, we are not making 20,000. That is 20,000 is accrued. Only we are making payment is 700, right? So cash 700, loan payment, and creditor settlements, other overheads. This is our contribution, the bank loan. So you will see the bank balance at the end of the period 480. Then the work in progress, of course, you see that wages 720. Can you remember the raw material 480? Overheads 1,800, 1,300. Depreciation is 800. So altogether so much. We transferred 1,800 to the inventory account. So you can prepare the inventory account also if you want. I think you can remember from 1,800, we transferred only 1,600 to the operators. So thereby inventory account, the balance would be, closing balance would be 200,000. So based on that, if you can prepare the what do you call this balance sheet, for the operation, not for the joint venture investors perspective. Now this is for the joint operation. You have to remember. Raw material 170. How do you get 170? You purchase 400, how much? 650, and you transferred to the work in progress here 480. So thereby you see that you purchase how much? You are taking 480, right? And I hope that you have how much? 650 purchase. Okay, 650 purchase. 650. 650. Okay. So the balance would be 0, 0, 7, 1. So that balance is here. Okay. Inventory 200. I think you can remember we produce 1.8 million of worth of inventory. Out of that, 1,600 were transferred, shared. So thereby 200 is the balance. Is it clear? 200 is the balance. Work in progress, of course, 780. How do you get the 780? I can tell you how do you get the 780 work in progress. Account is there. Here, you see. 780 is this. You get it. You put it here. And cash balance 480. It's taken from the cash account here. From this. So the assets, total assets, you get so much. I think you can remember the equipment 800 and 10% depreciation. It is 80,000. So thereby the carrying value is so much. The total asset is so much. Then trade creditors, I think, you know, 650 purchase, 450 something settles or the balance. Then accrued wages 250 and bank loan so much, and loan equipment we settle only 100. Therefore 200 is the balance and 700 is the liability, and altogether 950 net assets would be 1,400. How do you get the net assets? Total assets minus 950. Then the joint operators thing, you can remember, this is much more important. This is the contribution by the joint operator X. This is the joint contribution of the joint operator Y. You share this much of inventory because you are not selling the inventory to outsiders. Once you receive the output from the process, you shared it. Physically, you shared it. 1,800, but 1,600 inputs were shared, 50%, 50%. So thereby closing balance is this 1,400. It's tally. So that is basically the financial position and the financial position of the joint operation. Then we will look at accounting by a joint operator accounts by the joint operator. Okay. As I told you, you are sharing assets, you are sharing liabilities, you are sharing everything, you are sharing. Okay, income, expenses, assets, liabilities. 2.4 example, contribution cash by a joint operator. Now, we will see the same question, but has little impact. We'll see. Sydney and Melbourne Limited established joint operation to manufacture a product. Each company has 50% interest in the operation and shares output equally. To commence the operation, both companies contribute cash 1,500. 1st July 2015, each operator depreciate machines at 10% on cost. So each contribute 1,500. This is 2000. You have to remember this is 2016. This is something else, and this is a new balance sheet. I think, since you see that the figures are different. So cash so much, raw material so much, work in progress so much, inventory so much, equipment so much, total assets. Likewise, contribution 3 million, bank loan, equipment purchase, wages, accounts payable, overhead. This is the cash book. And balance, you see balance would be 420, I think. Cash balance, yes, 420. And the cost incurred would be, of course, 650, 400, 1,200, and cost of inventory so much. So thereby working progress would be so much. Prepare the journal entries to record Sydney's Limited and Melbourne's Limited for the year ended 30th June 2016. So that we have to prepare the journal entries for the joint operators perspective. Now, this financial statement is for the joint operation as a whole. Now we have to account for joint operators or joint arrangement. We'll see how to account for. First of all, Sydney Limited records, and you see the first double entry would be initially at the point when you start the joint venture. I think you can remember, according to the question, they are starting the business 2015 July 1st. 2015 July 1st here. So at that date, you have to debit the joint venture operation or cash in joint operation. Cash in joint operation is a separate account, JO means joint operation. Cash in joint operation 1,500. Since you are spending cash, your cash will be reduced. Now remember, we are not looking this answer from the perspective of the operation. Now we are looking at from the perspective of the operator, investor, right? So thereby we are opening a cash in joint operation account and we are crediting the cash account. Really, this is like a cash account, but we label it as cash in joint operation. Okay, then what happened is, according to this question, you see that inventory is work in progress is 650. Cost of inventory is 1,600. 1,600, but inventory balance is 200. What do you mean by that? Now, when you look at this question, even though you will produce, your output would be 1.6 million inventory. Agree or not? 1.6 million inventory. And you see the balance sheet, only inventory is 200. What do you mean by that? That means 1,400. How much? 1,400 withdrawn. They have produced 1,600. Okay. And the balance sheet only 200. Balance sheet only 200. So thereby, what happened? 1,400 is the distributed, taken, inventories taken out, or inventories allocated to joint operator. I think you can remember in partnership accounts, what we do is you allocate the profit, because partnership is there to making profit. But in this example, we are considering a business operation where you shared the final output. But if you are selling this final output, then you can share the profit. It's a different story. Right? But here we share the final output. So thereby, make a dekem bedano. So dekem beduhama, how much? You get 700. Okay. So what happened to your the capital investment in joint operation then? Investment in joint operation should be reduced by 700. 700 reduce, 700 reduce. Okay. That is the final outcome. So the journal entry, here the journal entry would be cash in joint operation this much and cash so much. The final results, what I'm saying, the final results would be, this is the journal entry for the final. Final will be inventory. Inventory would be debited to the 700 for the, say, investor one, right? Then the cash in operation, right? Cash in JO, JO means joint operation, would be 700 credited. What happened is the initial cash in joint operation account will be reduced by 700,000, and there will be an entry in your consolidated financial statements from the joint operation as 700 inventory. That's all. That is the ultimate end results. Okay, but to arrive at the end results, as we told you at the beginning, you are recognizing your assets separately, you are recognizing your liabilities separately. If there are expenses, you recognize expenses even. We will see how you recognize. Here, raw material in joint operation debit, because in this balance sheet, you have the raw material of so much, 100, you see. Making bhagyak api gannawa, raw material. See? So 50%, because we are focusing on the Sydney limited accounts. So debit raw material in joint operation, work in progress in raw material, inventory in raw material, in equipment in raw material, and finally we are getting a new thing, inventory. This inventory is what we get from the output. So we are debiting that. Then what we do is basically accounts payable, we are crediting so much, accrued expenses, we are crediting so much, bank loan, we are crediting, and cash in joint operation will be reduced by that particular amount, 420 divided by 2. 420 divided by 2, this one. Cash, 420 divided by So what you do is, instead of debiting cash book, what we do is we will reduce it from the cash in operation account. So that is the entry. And also depreciation account expense 750 debit and accumulated depreciation 750 debit. That is the accounts in the books of the what do you call Sydney Limited. So coming back to the things which I want to highlight. Okay, then what happened is, what we discuss is joint assets in joint operation. I think similar way we will do it in the similar manner, but here it says something little bit. In the illustration example 2.2, joint operator contribute cash to the joint operation. However, in some cases, a joint operator may contribute assets other than cash to the joint operations. For example, one of the joint operator in mining arrangement may also manufacture mining equipment. This joint operator may contribute equipment to the joint operation, while the other operator may contribute cash. In certain cases, you see, the joint operator increase in the code of Melbourne would be the same as, so even the Melbourne one would be same. There's no difference. There's no difference. If I am putting the journal entries again to you, journal entries would be, for the first Sydney one, the final journal entry would be like this: cash in joint operation, cash in joint operation, okay, then cash, that is journal entry 1. Second one, inventory. Then so cash in operation, right? Cash in joint operation. Okay. Third one, depreciation. And cash in joint operation. Okay, that's how you put the double entry for the where is my yeah, not this one, where is yeah. So basically that would be the double entry. The figures would be, I think I can take the figures. Depreciation here, the depreciation is 750, 757, yeah, 75, because you purchase equipment 1500, sorry, yes, Purchase equipment is 1,500. Yes, I'll take it. Okay, simply introduce 1,500 beginning of the operation. So you debit it to the cash operation account. You reduce the cash by that much amount. Debit and credit. Okay. The inventory you are taking, how much? 700. 600, yeah, 600, 400, yes, 700. So 700 inventory you are getting, that is your portion. And the final one, cash in joint operation, so much, creditor. Depreciation, of course, so you are acquiring 1,500 worth of machine, but you take only 50% because your ownership, your control is 50%. So thereby 50% means 750. For the 750, 10% is 75. That is the case. So the balance would be this minus this minus, it has to be this 750. 75. So that is the case here. In addition to that, you can put other journal entries, but much more important 3 journal entries are these. Okay. So I have completed this one. Then similar, what do you call, similar answer for the other one as well. Shall we go to the next one? Okay. So we are in the example 2.32 hours yet remember. So the records of Melbourne is same. I'm not going to do same thing because same way the Melbourne has contributed. But what if they contribute something else, not in cash, the question. For example, one of the joint operator in a mining arrangement may also manufacture mining equipment. This joint operator may contribute equipment, the joint operation, while the other operator may contribute cash. Where the operator contributes non-cash assets to the joint operation, the value of the contribution is effectively the fair value of the non-current assets. Since the one operator contributed 100 cash and the other operator non-current assets, then the both parties agree to join. There would have to be arrangement that the non-current assets being contributed had a fair value of 1,000. If all operators contributed non-current assets, then some of the valuation of contribution would need to be made by the parties involved. Basically, however, assume that operator ALC Limited carries a non-current asset at fair value its account, for example, an item of plant. And if this asset is contributed to joint operation where the operator Spring Limited contributes cash 1,500, 100,000, the journal entry contribution in the records and is as follows. Now here in this example, what we do is the contribution by two parties different. One party is contributing cash, the other party is contributing a machine. So when Alice contribute a machine, what happened is Alice, the plant account will be credited and debited plant in operation 50. And since in the operation, there are two types of assets. No, I'm not using now Excel sheet. The Excel sheet, of course, Excel sheet is just to show you 3 journal entries, that's all. I hope that you can see the Excel sheet now. Excel sheet is to show the earlier case, Sydney's account, these 3 entries, but I put several entries. What I'm telling you is that these are the important entries. That's all. Now just see whether you can see the PDF document. Now what I'm trying to say here is that the both parties are contributing 100,000 to the joint operation. But these 100,000 are not in terms of all cash. First one is cash. Okay. Second one is not the cash. Second one is plant. Now, once you put this into the joint operation, these are assets of the operation. So thereby, each party will get a 50% of each one. Here also 50%. So thereby, from this plant, you get 50%, and from the cash, you get 50%. This is the Alice book. But if you have put in the Spring books, in the Springs books, what happened here is the cash so much, plant so much, debit, but here it has to be cash, no? Because you are investing cash, not the plant. This 100 is cash. Okay, that's the opening entry. That's the opening entry. Okay. Assume that Alice contributed non-cash assets with a fair value of 1,000 and a carrying amount of 8, while the Spring contributed cash 100,000. Alice cash then recognizes a profit on sales half non-current assets, namely 10. What I'm trying to say is that now, even though carrying amount is 80,000, if the Alice says that the fair value of assets given up or taken into the joint operation is 100,000, which is more than 40%. So thereby profit is 20. Profit is 20. So what we have to do is we have to recognize the gain on sales of plant. So thereby in the Alice entry, the cash is 50. That's okay, no problem. But the joint plant in joint operation, you take the value based on the carrying amount, that is 40,000, 8,000 into 50%. And plant is 80,000 credited, and this 10,000 is called gain on sales of plant. So that is the entry in the books of the Alice. But in the books of the Springer, it's not the case. You take cash 50,000, here credit 100,000, but 50,000 cash in joint operation and plant in joint operation another 50,000. There you don't recognize any gain or loss. Is it clear? So if cash is introduced by both operators, it's very simple. If some other non-cash item is introduced, carrying amount and fair value, if these two are equal, there is no problem. If carrying amount is less, fair value is more, then there is a gain, of course. Opposite. If carrying amount is more, fair value is low, then you will have a loss on sale of plant or whatever. So that is, of course, example 2.4 24.3. You see here, this is with, introduction of cash and non-cash both. 1st July, Tweed Limited and Heads Limited established a joint operation to manufacture a product. Each company has a 50% interest in the operation and share output equally. Share output equally. To commence the operation, 1st July 2015, Tweed Limited contributed cash 1.5 million and Head contributed equipment, had a carrying amount of 1 million and fair value 1.5. Earlier case, it was 80,000, 100,000. Now 1 million, 1.5 million. So thereby you say the excess over carrying amount is 500. So there is a gain. So you have to recognize a 50% of this. The equipment depreciated in the joint operation account at 10% on cost. So thereby it's depreciated. You see 10%. Okay. We'll see now this is the financial statement of the joint operation. Not the individual. You have to remember the operation as a whole. Cash, you have this much, this much, this much, and accumulated depreciation 150 and so much. Liabilities, contribution, bank loan, wages, etc. Prepare the journal entries in the records of each of the operator for the year ended 30th June 2016. We will first focus on Tweed. Of course, Tweed introduced the cash. So thereby, when the introduction of cash, very simple, cash in joint operation 750, And equipment in joint operation is 750, but cash creditors 1.5 million. So you get 50% of cash and 50% of plant. 50% of cash and 50% of plant, you will calculate based on the fair value of the plant. Of course, cash fair value and the face value, 750, that's true, but this 750 is based on the fair value 50%, right? Then you take raw material 50%, work in progress 50%, inventory, and inventory 700. How do you get 700 inventory? Here, remember, you produce 1,600 inventory, but the balance sheet shows only 200. So thereby 1,400 inventory being charged. So 50% is 700. And accumulated depreciation, 50% you take, accounts payable 50%, payable 50%, cash in joint operation, of course, cash balance is 420. In this, you take the 50% to reduce the particular cash in operations. But in the records of the heads, accounts entries are almost same, but there are two variations. One is this, you see, cash, of course, 750. And here 50% we take based on carrying amount. 50% we take based on carrying amount. And equipment value is 1 million, that is carrying amount. And this 250 is from 500,000, 50%. That is how you calculate. Other things, other entries are almost same. Almost same. Okay. Now, there is a separate adjustment in the work in progress, equipment in JO, in the books of the Heads Limited. Heads Limited. You have to remember Heads Limited. So there is a 25,000, what do you call, story. The depreciation recognized to it limited is 75. Agree? Why depreciation recognized 75 here? Here depreciation 75. Because the total depreciation is 150,000 because the assets transferred to the business operation 1.5 million. 1.5 million into 10%, 150,000. So from that you take 750. But here depreciation, you 750 you recognize in the business operation, but you have to remember, actually speaking, however, the equipment in joint operation has been recognized by the Heads Limited only 500. Initially, we recognize only this. So thereby, what happened is the half of the original carrying value heads needs to be recognized 50 depreciation. So this is the depreciation. So thereby there is a difference between 75 and 50, that is 25. So what you have to do is from 25,000, you need to make a provision. You have to reduce work in progress, inventories, and inventory. So thereby, how do you allocate this 25,000 is based on the pro rata value 400, 100, 700, which is given in the balance sheet. 400 here. 400 you recognize here. 400, 100, 750 you recognize. Remember, you don't have the depreciation in the raw material. You have the depreciation in work in progress, you capitalize. When you talk about the inventory in joint venture, there are depreciation. When you talk about the inventory, of course, depreciation is there. So thereby double entry would be equipment in joint operation in the books of heads, debit and respect to work in progress and inventory will be credited. So I think with this example, we are not going to discuss the management piece of the joint operator. Of course, if you want, you can study. Then we have the disclosure requirement. So with that, today's session is over. If you have any questions, you can raise. Okay, then shall we stop the class? Thank you very much.